So I'm going to touch briefly on the story of the subprime meltdown. Many of you may already know the story, but I'll give some of the drivers. So mortgage rates were going down and the real estate prices were going up. So what people did was they bought houses, whether or not they lived in them, because they felt that if they bought a house and sat on it, that the value of the house would go up and they would make money. That kind of speculation and, frankly, greed caused the overheating of residential markets in the late 2000s. It takes more than one person to make this debacle occur, and I like to think of it as unchecked self-interest from multiple people up and down the entire ladder caused this crisis. And not, I don't want to paint these guys out to be like crooked people. This is like a nice young family trying to buy a house. Now they can afford a nice 2-bedroom condo, but they're tempted to buy a 4-bedroom, 3,000-foot house because they can get a cheap mortgage and they have an expectation of that if they stay there a couple of years, they're going to make all this money on this house, right? But they are basically just needing a housing for three of them. They have a little bit of incentive and a little bit of greed to try to make money on the house. This person is the real estate agent. So if she sells a house, she'll make some percentage of the sales price of the house. Let's call it 7%. So if she sells a condo for a couple $100,000, she makes 7% of a couple $100,000. If she sells $1 million house, she makes 7% of $1 million. So she has incentive for selling more house to the buyer than they want, need, or prudently should buy. So they both have now incentive to buy more house than they maybe prudently should buy. This next person is the loan broker who has to make a loan to support the family to buy that expensive house. Loan brokers, same thing. The higher the loan, the more their fees. So they have incentive to give a higher and higher mortgage. Even if you don't need the mortgage, they want to sell you the mortgage. If you can qualify for a bigger house, they want you to buy a bigger house so they get a bigger fee. This person is the appraiser. The appraiser has incentive to keep appraising the numbers based on this crazy market, even though it may not be a long-term smart investment. They give an appraiser that conforms with the loan that supports this buying of this house. This person is the warehouser who gathers all the loans ready to sell it to the markets. This is just paper that loans that can last 30 years. So this person works with the investment banker over here, who then sells it to the markets. So they take the big stack of paper and converts it to cash. There's an insurance company that's trying to create some insurance products to support the mortgages and their defaults. The next one are the investors, institutional investors, who are always seeking a slightly better return for little or no increase in risk. So they're buying mortgages because they think mortgages are always safe. They're not always safe, but they thought they were. And rating agencies who put a stamp on this pile of securities saying that they're safe loans. And they're paid a fee for that opinion. And they know that if they give a contrary opinion, they may not get the job. So they now have a disincentive for actually being critical of the creditworthiness of that stack of mortgages. Then you have the US government, which enables all this to happen. In some ways, likes to see wide home ownership and have federal agencies, Fannie Mae, Freddie Mac, that are involved in the mortgage business to kind of make this whole thing work. So every one of these steps has people that are part of having this couple buy more house than they should, taking on a bigger mortgage than they should, which creates a bubble. And then the bubble collapses. And that's exactly what happens. So this rise that we saw through the 2000s up to 2008 collapses abruptly. And we see foreclosures, bankruptcies, repossessions, just a very, very ugly thing. And many of the more venerable institutions, I don't know if they're all good institutions, but many of them either went out of business or had their wings severely clipped. Bear Stearns and Lehman both went out of business. EIG insured a lot of these very fancy credit default agreements. They needed a bailout. B of A bailed out the largest underwriter of loans in the United States countrywide. Fannie Mae and Freddie Mac sustained massive losses, again propped up by the government. And GM declares bankruptcy, and it gets propped up again by the U.S. government. So it was a very scary time for the American economy, which created a very scary time for the global economy. Regulation world, more leaders and businesses fought to restore controls and normalcies in the markets, and took some pretty severe actions, some of them controversial, to stabilize the bleed on the banks and the failures of banks, and propped up much of this to make sure that there wouldn't be even a wider issue. And there were some reforms on the practices that hopefully will avert this from happening. The economy itself is part of a cycle. So we're looking back to 1920s and see all the economic cycles here. And we have this dip right here in this gray portion, which is the financial crisis 2008, and we've come roaring back. In fact, the stock markets are close to all-time highs in the recent days. So we've come way back from a very, very depressed period to record high valuations. So summarizing chapter 1, the objective of business management, increase value of their firms. We often measure that through the use of free cash flows and weighted average cost of capital to derive a financial value. And there are many forms of forming a business, starting with the simplest, which is sole proprietorship, going to a partnership, which could be general or limited, and to corporations, which could be a regular C corporation, a subchapter S corporation, or a benefit corporation. And then financial markets and institutions create securities that then serve to efficiently move money around from those who have money to invest, who are sources of debt or equity, to the users of cap, corporations or individuals. And the subprime mortgage meltdown led to the crisis of 2008, which was catastrophic, but we've recovered largely after 8 years from that horrific experience. So that's the end of chapter 1, and we'll have one more video covering chapter 2.